Well, yes, they have a strategy to broaden their brand portfolio. NIO was launched as a more premium offer with a services-oriented business model, which is why they spent so much in battery swapping and in NIO House. So that spread a lot of their CapEx out, a much higher burden and more burdensome business model than a typical automotive company. But they do have a strategy to diversify the brand portfolio. There are two brands coming. I'm sure we'll hear a lot more about that in the Beijing Auto Show coming in April.
NIO is now on the brink of a pivotal moment in the stock market. With shares down 46% year-to-date, investors are closely watching the company's trajectory. Top analyst Vijay Rakesh's recent analysis adds fuel to the fire, shedding light on NIO's current challenges and potential opportunities. How will this analysis impact your investment decisions?
And finally, let's take a look at NIO. The Chinese EV maker getting a downgrade today to underweight over at Barclays. The price target knocked down a peg to $4 a share. March sales for 2024 models missing estimates in a big way. And the analyst says this poses a significant risk for NIO's ability to meet consensus estimates for the remainder of the year. Those shares down about 2.5%.
Renowned analyst Vijay Rakesh has recently conducted a comprehensive evaluation of NIO stock, and his findings are far from optimistic. While acknowledging NIO's status as a technology leader in China's EV market, Rakesh has underscored the mounting competition and high pricing obstacles impeding wider adoption. His caution is particularly pronounced after NIO's guidance for the March quarter was downgraded by 36%, raising serious concerns about meeting delivery targets. Rakesh's assessment prompted him to downgrade NIO stock from buy to neutral and significantly lower the price target from $15 to $5.50. This move reflects his apprehensions about near-term margin pressure and challenges in meeting delivery targets. While Rakesh's opinion carries weight due to his top 1% ranking among street stock pros, he's not alone in his caution. 7 other analysts have also issued hold ratings, contributing to a consensus moderate buy rating for NIO shares. Now, let's look at the investment thesis regarding NIO. Previous analysis emphasized the ongoing downward trend, signaling an opportunity for long-term investors to leverage market volatility through dollar-cost averaging. Critical long-term support zones were identified within the price range of $6.10 to $4.35, where investors could strategically position themselves for potential market recovery. Continuing with this strategy, the rationale for maintaining a buy rating for long-term investors remains strong. The DCA method allows investors to lower their average cost basis, preparing for an eventual rebound in NIO's stock price. From a technical perspective, NIO appears to be in a consolidation phase, with candlestick patterns showing no significant upward or downward movement. This neutral stance, supported by technical indicators like RSI and stochastic RSI, provides long-term investors with time to thoroughly assess the company's prospects. Now, let's look at some good news regarding NIO's sales performance. In Q4 2023, NIO achieved $2.2 billion in vehicle sales, marking a 4.6% year-over-year increase. This growth was primarily driven by higher delivery volumes, although it was partially offset by a lower average selling price due to changes in product mix. The ASP stood at $43,500 this quarter compared to $53,400 a year ago. One significant highlight is NIO's significant traction in the SUV market, with 67% of vehicles sold in Q4 2023 being SUVs, compared to 52% a year ago. NIO's vehicle margin also reached 11.9% in Q4 2023, showing a 510 basis point improvement compared to the previous year. This positive trend was attributed to various factors, such as reduced material costs per unit and addressing inventory provisions. Overall, revenue grew by a modest 12.9% year-over-year to $7.8 billion, driven mainly by a 43.6% growth in sedan vehicle deliveries. Despite facing challenges such as increased battery costs per unit and changes in product mix, NIO improved its vehicle margin from Q3 onwards, reaching 11.9% by Q4 2023. Now, did you know that NIO is aiming for a rebound in the first quarter of 2024? The management targets vehicle deliveries from 31,000 to 33,000, with a slight year-over-year growth expectation of approximately 0.1% to 6.3%. Although there was a 12% year-over-year decline in deliveries during the first 2 months of Q1 2024, reaching 18,187 cars compared to 20,663 in Q1 2023, March 2024 saw an uptick, with at least 12,854 vehicles delivered, matching the figures from the same month in 2023. This dip in deliveries during January and February can be attributed to the Lunar New Year, a period when many Chinese individuals traveled to spend time with their families, affecting both EV production and sales. Typically, this seasonal impact extends into February, with production levels normalizing only in March. Despite these challenges, management forecasts revenue to range between $1.479 and $1.562 million for the first quarter of 2024, indicating a modest year-over-year growth of approximately 1.7% to 3.8%. Additionally, they maintain their vehicle gross profit margin guidance of 15 to 18% for 2024. Moreover, we also see NIO switching gears towards capturing the mass market. They're gearing up to introduce two new mass market brands, codenamed Alps and Firefly, to tap into a broader customer base. Alps, aimed at the 200,000 to 300,000 yuan market segment, will debut in the second quarter of this year, offering thinner battery packs and next-gen electric motors. This move signifies a shift from NIO's premium branding to a more accessible market. To complement this strategy, NIO plans to deploy 1,000 new battery swapping stations in 2024, significantly reducing charging times to just 5 minutes. This bold move follows partnerships with major Chinese automakers and underscores NIO's commitment to battery swapping technology. To ensure efficient operations, the company aims to equip these stations with advanced technology, including NVIDIA Orin X chips and ultra-wide-angle LiDARs. However, this expansion comes with a hefty price tag. NIO is expected to invest over $592 million in capital expenditure to set up these stations, highlighting the scale of their ambition. But before we move on, we just want to thank you for watching this far in the video. Another challenge NIO faces amidst its growth trajectory is the escalating price wars within the electric vehicle industry. Despite maintaining momentum in January and demonstrating delivery potential, NIO is grappling with immediate obstacles due to mounting pricing pressures. The competitive landscape is intensifying, fueled by new launches from rivals like XPeng, BYD, Geely, and Great Wall, alongside the impending entry of Xiaomi. BYD's announcement of upgraded model lineups with significantly lower starting prices for 2024 has triggered a domino effect of price reductions across the industry. This aggressive pricing strategy, compounded by Tesla's similar moves, reflects efforts to navigate through overcapacity and subdued demand. The recent price war underscores broader industry challenges, including overcapacity, muted demand, and evolving market dynamics. However, as Tesla and BYD grapple with preserving their operating margins, legacy automakers' delayed EV plans could help alleviate supply-demand imbalances in the segment. Despite these headwinds, NIO remains resilient, with robust cash reserves exceeding $4.6 billion, providing a buffer against financial strains. Furthermore, NIO's focus on maintaining margins and abstaining from the price war positions it strategically for long-term sustainability. Moreover, NIO's improving vehicle margin, evidenced by a 90 basis point increase quarter-over-quarter to 11.9% in Q4 2023, signals positive momentum and underscores its financial health and operational efficiency. As macroeconomic conditions stabilize and NIO continues its sales force revamp, the company is poised to weather the storm and emerge stronger in the evolving EV landscape. So now, even though NIO hasn't hit profitability yet and lacks a specific P/E ratio, other indicators paint an optimistic picture. The EV/sales ratio is in line with the sector median, suggesting a fair valuation. Additionally, the price/sales ratio slightly exceeds the sector average, indicating investor confidence. While NIO doesn't pay dividends, its growth potential and market positioning inspire confidence among investors. With shares trading at less than 1.0 times forward revenues, the risk-reward profile appears favorable, presenting NIO as an attractive growth stock. Moreover, NIO's relatively low valuation based on revenues offers a cushion against downside risks compared to many other EV companies. If NIO can demonstrate margin improvement in the coming quarters, there's potential for significant upside in the stock price, making it an enticing proposition at its current price. So, given NIO's promising metrics and growth prospects, would you consider investing in this EV powerhouse for the long haul? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.